Well, I think the initial exuberance by the markets may have calmed down, which I think is a positive development. But broadly, we think that the overall economic growth scenario is improving. We have reduced the probability of a recession now to 25%. We were never in the doom and gloom scenario a year ago. Markets were saying 80%. We were at 50% in January of 2023. We've been gradually reducing that. It's now 25%. So we are very, very comfortable with the way the economy is going. And if anything, it sort of helps the Fed to start in that sort of shifting in the interest rate trajectory.
Have things moved a little dovish, though? I mean, it felt like the tone became a little dovish when Fed Chair Jerome Powell was speaking on day 2 of his congressional testimony last week. Is that the sense you're getting?
That's right. But the shift, I think, happened, if you remember, at the end of last year, the markets were calling for 175 basis points, which in our view did not make sense. We expected a much more sort of sober 75 basis points and not starting in March. It was too early because there were no signs of sort of the easing of inflation down towards 0 to 2% or the unemployment rate. So I think that the markets adjusted accordingly, and the Fed is now starting to manage expectations for the beginning of that to take place, alongside the ECB, which we always felt the ECB was going to be cutting rates before the Fed, and we're still holding on to that.
But when someone as important as Raphael Bostic, good morning to you, by the way, my friend, someone as important as Raphael Bostic says he's worried that cuts could potentially, and I'll quote verbatim here, unleash a burst of new demand that could reverse the progress towards rebalancing supply and demand. That would create upward pressure on prices, the threat of which I'll call pent-up exuberance, is a new upside risk that I think bears scrutiny in coming months.
I couldn't agree more. I think that that's the reason why we didn't see the Fed having to cut rates by 175 basis points, and we didn't see the reason why the Fed should start cutting rates by March. They have time. They can see the unemployment rate, they can see the CPI, they can see PC, take it on meeting by meeting and then adjust. So gradually, I think we should see some cutting simply because we are in over-tightening mode. So we should see some adjustment, but not too much, because the risk there, exactly as our friend mentioned, is a potential policy risk and a U-turn.